Welcome to webinar 4 of the Investment Readiness series. Today we'll be talking about private investment fundraising strategy. Your fundraising strategy should be adjusted and refined based on the stage of your company, your performance, your industry, even macroeconomic conditions and investor sentiment and many other things. For example, just 2 or 3 years ago, special purpose acquisition vehicles or SPACs were all the rage as kind of an alternative way for space companies to go public. And right now, most would agree that the companies that took that route took a bad decision going for a SPAC. So there's these kind of trends that you have to take into account. And generally right now, private investments are cooling down across all sectors, including space. So keep that in mind. But generally, most important is that your strategy, your fundraise strategy, aligns well with your business model and your equity depth and working capital requirements. Also, it takes a lot of time and it takes a lot of effort to raise funds. And while you're out raising funds, you're spending time that you could have been spending on product development or sales or other critical activities that you should be undertaking as a founder. So having a good fundraising strategy also helps you minimize the disruption to your venture. And if you have a need for support, make sure to contact us. We're happy to have a chat because we provide specific services to help you raise funds in cooperation with our finance partners and our large investor network in the space industry. Today, we'll cover 5 key takeaways that are important for a good fundraise. So let's get into it. First up is to raise capital in stages as you remove risk. So most startups, they raise money in concrete stages throughout the lifetime. So you hear terms like seed stage, Series A, Series B, growth stage, etc. And the definitions are kind of changing, but mostly they just simply refer to the stage of the company where it finds itself. You know, it's kind of maybe pre-product, pre-sales, pre-revenue, whatever. And the amount of money that is being raised increases as the needs of the company increase. Basically, the burn rate or how much money you're spending increases, of course, as you are growing. And since fundraising is such a time-consuming process, why would you raise money in several steps? You know, why not raise most or all the money that you need in one go? Mostly it's because in the early stages, you're simply too risky to raise all the capital that you need. Investors would never go for it. And second, the price at which you would raise this capital would be too high. And that is, your valuation would be too low. So you would lose a big chunk of the upside potential of your company, a big share of your company. And as you raise funds, step by step, you remove risks and you better prove your business model. And investors will be willing to invest more at a higher price in the later rounds. So this minimizes dilution, which means you keep a larger share of your company. And ultimately, this increases your potential upside or how much money you make in the long term. So raising too much money too early can also make you kind of a bit lazy and make you lose focus. You know, if you have to return to the market every few years to raise more capital, it kind of forces you to prioritize your efforts. If you have a ton of cash, it may keep you from continuously testing your assumptions or ensuring market fit and listening to market feedback. So that's something to take into account as well. And also, before there are customers, there are investors, right? And these are the kind of the next best thing to customer feedback, to listen to investor response and see and kind of, you know, do a reality check on your thoughts and assumptions. Minimizing dilution is not the objective of a fundraise. So the objective is not to keep as large as possible share of your company during the fundraise. As an entrepreneur, there's a lot of pressure kind of to achieve a higher funding valuation in each round that you do. But in the end, private valuations are more related to like the competitiveness of the financing environment or trends in investing than the actual or potential value of your venture. So it's crucial to kind of strategize your financing carefully, planning it like all the way to cash flow break even, while you're aiming for the higher end of the market valuation in each round. So rather than trying to maximize valuation around a single like hot moment in the market, it's better to optimize demonstrating momentum through a series of increasing funding valuations. And that said, having down rounds or a fundraise that is at a lower valuation than your previous fundraise, they have consequences. You can suffer twice, right? Basically, it's more dilution this round and more dilution retroactively for the prior rounds. So, don't go for this huge valuation if you can. Try to set a fair valuation, even if it's not the maximum that is available at the time. And overall, the focus should be on avoiding running out of cash and thinking about the next round now already. And by doing so, you can optimize your financing strategy and increase your chances of success. Go for the lowest cost capital considering your circumstances. So as your business grows and becomes more predictable, you can consider shifting from equity-based financing to debt-based financing. But of course, such a transition requires a certain confidence that your cash flows from the operations are going to be sufficient to pay for the debt. And of course, it seems like a good thing to do because you can take debt and not give up any equity in your company. But it's also dangerous because the payments will come due, and what if you don't have the money to pay them? So it's important to be kind of conservative and avoiding leverage or avoiding too much leverage when there's still like a significant, say, execution risk involved in the company where you still have uncertain cash flows. Selling equity may be expensive, but debt holders can demand also certain rights and security that also limit your options if things don't go as expected. So this is something to keep in mind. Debt works for businesses that can confidently afford debt and can benefit also from the tax breaks that it provides. But for early stage businesses, it's probably a good thing to minimize debt and limit any long-term obligations while you focus on raising equity to fund your business. Escape the traps of venture debt. So there's several types of debt, including bank loans, leases, and venture debt. Bank loans, as we just discussed, are usually reserved for more later stage businesses with predictable cash flows and profitability. Leases are kind of a form of debt that is granted in conjunction with the purchase of assets that can serve as a security for the loan. And venture debt is a specialty loan provided to high-risk startups that aren't yet profitable and may have, limited or non-existent cash flows. And venture debt can be appealing for a couple of reasons. It can provide more time between equity rounds. It can allow companies to extend their runway and achieve higher valuations. It can also help owners retain larger ownership stakes because of the lower dilution. And finally, by bringing additional capital earlier, it helps the company achieve milestones and liquidity sooner for its investors. But there are risks associated with venture debt. Venture debt lenders often demand a security interest in the startup's intellectual property, which gives them a lot of leverage in the event of a default. It can lock a company in. It can make it difficult to pivot or adjust milestones in response to certain challenges or risks. And also, venture lenders can negotiate for more when a company is in distress, as they basically control the cards. So if you do decide to take on venture debt, it's important that you choose your lender wisely. The terms of the loan should be well considered, like interest rate, obviously, payment schedule, yes, but also loan security, warrants to buy stock, and other funding covenants. So it's crucial to select a lender that has a reputation also to work with the companies and the investors when problems occur, rather than one that is likely to pull the plug. Lastly, put good thought into how much money to raise. So when it comes to determining how much money you need to raise for your startup, it can be quite confusing and complex because you have to take into account many things like valuation, burn rate, critical objectives, time, dilution, and more. And investors, for example, might prefer that they raise less initially to minimize risks, while you and your team might want to raise more to scale more quickly. But there's basically 4 proven approaches that can help you narrow down the amount of money that you need to raise to fund your growth. First approach is a milestone-based approach, which involves basically creating a financial plan from the bottom up that determines the amount of time and the amount of resources that you need to achieve specific value-adding milestones. This approach can be comprehensive, it can also be inaccurate, might underestimate the time and resources that are required, might lead to kind of a bloated plan. It might lead to a reduced ability to react to unforeseen things. So this is something that you can keep in mind. The second approach is the burn-based approach. It's relatively simple. It involves determining a reasonable monthly burn rate, so a monthly amount of money that you're willing to spend, and estimating the time that is required to achieve meaningful progress, along with the time that's needed to raise the next round. It's an approach that is more applicable to earlier stages of startups, and it basically focuses on living within a set budget, which generally is a good discipline. The third approach is the runway approach. It involves setting a specific target runway period based on industry and stage. And this approach requires a lot of discipline, as your startup has to gradually adjust its burn rate, trying to never hit the ground. And if your cash falls below the target runway, you start, cutting costs to gradually extend it, managing risks before you run out of money. So it's a kind of a tricky one, but usually in any case, it's a combination of these kind of methods. And lastly, the fourth one is the dilution approach, which basically involves raising funds beyond what your plan requires to minimize dilution. And this kind of approach is more applicable if your startup is hot and you're in a hot industry and you can afford to do such a raise. Ultimately, determining how much money to raise depends on a variety of factors. Like I said, requires careful consideration. And by using one or a combination of these approaches, you can better narrow down the amount of funding that you need to achieve your goals and successfully grow your startup. Of course, these are just some of the things that you have to keep in mind as you raise funds, and detailing the entirety of your investment strategy is complex. It requires a significant amount of time and effort, that you probably are better off spending on product development or sales. So if you're in need of support, make sure to contact us. We're happy to have a chat. We provide specific services to help you raise funds in the space industry in cooperation with our finance partners and our large investor network. Thank you for watching.